Hi there, and welcome to the Business Growth Factor. This is where we have conversations about building better businesses. My name is Lyndon Smith, and I'm joined by my co-host, Joshua Lyyenhorst, today. And we're going to be discussing some of the financial pillars that you should be considering in your business. These will be your profit and loss or income statements, balance sheets, cash flow forecasts, cash flow statements, and break-even analysis. So thanks for joining today again, Josh. Thanks for being here.
We here.
And do you want to sort of step into that conversation for us? It's like I said, we're really just touching on a couple of core components when considering financials in your business and why it's important.
Yeah, and maybe before we do, I don't know, do we want to introduce ourselves a little bit and who we are and why people might want to listen to this a little bit, or if you want to start us off, Lyndon?
Yeah, sure. So as I mentioned, my name is Lyndon Smith. The podcast is about we're basically having conversations around building better businesses, and the goal is really to empower and equip everybody that's on this call with some tools and some resources to take and apply in their business. So it's just a free sort of conversation that we're imparting a bit of wisdom, knowledge, and experience with everybody that's listening on the call. My background, I worked in the mining industry for close to 2 decades. Got very process-driven, in a very process-driven environment for about a decade. Worked for a robotics and automation company, and switched gears, moved into business coaching and consulting. I've got a company called Expansive Edge, and we support service-based businesses in documenting their processes and effectively just building a business playbook that empowers their team to be able to access all the information that they require to be successful and to do their jobs efficiently and effectively every single time, consistently. So that's me. I'm going to hand over to Josh, and we'll take it from there.
Sounds good. So with a background in mining, could you say that your background is kind of gold? You've got like a golden background.
Golden background, yeah.
Joke for the day. Joke for the day. Okay. So my name is Josh Leyenhorst. I'm the founder at BasePoint Accounting and Finance, or BasePoint CPA. So we are an accounting firm, work with small, medium-sized businesses, primarily in the contracting construction space, kind of providing help with the whole finance side, all the way from bookkeeping up to virtual CFO services and the exit planning that happens after that. So the full story of the business. And a little bit on the background front. I used to be a scientist, and so naturally I became an accountant. But at the end of the day, what it is making decisions based on numbers. And so that's what we're going to be talking about today, is using the numbers of your business in order to make decisions and where to go in the next steps.
I feel like I got to pop in a dad joke there, but I just can't come up with that. I'm thinking something around like business scientist or.
Yeah, well, when it comes to you, Lyndon, just hop in there and go for it.
I might interrupt you in the most critical
inopportune time.
moment of your conversation. Yeah.
when it's like the climax of talking about accounting and finance, and everyone's just on the edge of their seat, and then you're gonna hop in with a good joke. That sounds good.
That's gonna happen. Yeah. Watch out for it. Watch your space.
That's right.
Yeah. All right. Super. So thanks for the introduction there, Josh. So when we're in business, I mean, there's a few core financial components to consider. I mean, we could get a pretty exhaustive and extensive list, but for the purposes of conversation today, we're specifically going to be looking at your P&L or income statement, depending on where you are in the world and what you call that. A balance sheet, cash flow forecasts, cash flow statements, and break even. So we really want to look at like, what are these documents telling us, or these statements? What are they telling us? Why is it important to do a cash flow forecast or a budget? And why is it important to understand your break even? What's that all about?
Mm-hmm. Okay, yeah. So if we start off with financial statements, I mean, really what they are is I think the formal definition is something along the lines of, it's a formal written record of the financial performance and position of a business, which sounds very yawnish, but maybe the best analogy of financial statements is kind of like you know how at the end of the month you get this email from Google saying, if you use Google Maps, saying, hey, here's where you have been last month, right? Sometimes it feels a
Yep.
little bit creepy, but it gives you this whole map of where you've been, what you've done, as far as destinations go. And so it's kind of a historical record. And so in a similar fashion, you know, your financial statements kind of show you where you've been and where you are as of a certain point. And so, you know, in terms of what they're made up of, you have your income statements. You had mentioned that a lot of people know it as the profit and loss statement or the P&L. So what that does is shows your profitability. It shows how much revenue that came in, what your expenses are, either tied directly to the delivery of your service or goods, and then also your expenses. And then at the end of the day, your bottom line, which is the bottom line of the income statement, which is your net income. So your income statement is all about profitability, your revenues, and your expenses. So, and then you have your balance sheet. And so your balance sheet kind of tells you where you're positioned. And actually, in the accountant academic space, they're trying to rename it the statement of financial position, which is a
Mm-hmm.
mouthful, which is why not many people use it outside of academic circles. We still call it a balance sheet because it's like 3 syllables instead of 800 or whatever a statement of financial position is. But what the idea behind the new name is, that's what it is. Like, as of a certain date, this is where your business is positioned financially. And so that looks at both assets, which are what you own, and liabilities, which are what you owe. And then at the end of the day, the accumulated profits in the company, which is called the retained earnings, or your equity, which is a combination of that and your share capital value.
Okay, excellent. And I mean, the word statement kind of alludes to the fact that we're always looking in the rearview mirror. So it's
Mm-hmm.
what's already happened. It's a record of, you know, what's happened in your business, how your business has performed, and what the statement of what is the term that you
Statement of
used?
financial position. Yeah.
That's it.
Yeah, exactly.
So that's looking in the past. And um, so why is it important to dig into these things? How frequently should we be looking at these documents, and you know, like and why?
Yeah, so that's a good question. I think a good cadence is, if you're not doing it, if you're doing it once a year, which is what a lot of companies do. I would venture to say most companies do once a year, and that's when they get their year end financials done. That's the point at which they see their year end, their income statement and balance sheet. I would say if you're doing that, try to move to quarterly. So at least every 3 months, you're looking at this. And then if
Hmm.
you're already doing quarterly, try to move to monthly. And again, it is looking back, right? Financial statements are looking back, but they tell you how you did. And so if you have a strategy, if you have a goal, you can start to measure against that. And then you can take that information and kind of project that out and say, okay, are we on track, right? If your sales target is maybe $1 million for the year, and you're halfway through the year, and according to your income statement, right, for the first half of the year, you've done $250,000, it sets the trajectory for the rest of the year. You're like, okay, we have to do another 750 in this next half year. So
Yeah,
although it's looking back, it does help inform you of what the future should look like.
absolutely. And sorry, so when you're planning, you know, putting your budget or your cash flow forecast in place, how I mean, you're obviously doing that with data from before, right? So
Yes.
you're leveraging these documents or these financial statements to help you prepare um, your forecasts or your budgets. Do you have any other like considerations around like specifically the income statement or your P&L and your balance sheet? Like, I mean, you mentioned that if a business is only looking at it once a year, they should be doing it every quarter. I'd argue that for smaller businesses, you'd be looking at that at least every month.
I mean, ideally, you want to go monthly. I think when I say quarterly to monthly, if you're only doing it once a year, you know, when you get your year end wrapped up,
Hmm.
move to at least quarterly. To asking somebody to move to say monthly is a big jump and a pretty big hurdle, and it probably won't happen. But yeah,
Yeah.
ideally monthly. If you can get a regular cadence of closing your books by say like the 5th to the 10th of the month, so that you can have some pretty up-to-date financials that you can look at on a monthly basis, that's ideal. Because then if you do dynamic forecasting, which we could talk at some point later, which is a bit more like Google Maps for your current journey, right? So we talked about how financial statements are a little bit like Google Maps summarizing where you've been. Dynamic forecasting is sort of like you've plugged in your destination into Google Maps, and it's telling you where to go and how you should detour. And so when you look at your financials on a monthly basis, it positions you to be like, okay, here's where we are now on the map. Here's where we want to go. Let's make this next leg of the journey. But if you don't do that on a monthly basis, and you're only doing it annually, you may have missed your destination by, I would say, a mile. But when we're talking driving, or even business, it could be many, many, many millions of miles. But well, maybe not with driving, but with business. And so if you look at it quarterly, at least there's points throughout the year where you're sort of recalibrating. You're saying, okay, how did we perform relative to what we were anticipating? And how are we going to get to our target? And so if you can do that monthly, that's fantastic. That's like the ultimate cadence to get into for sure.
So Josh, we jumped straight into dynamic forecasting there. I wonder if we can maybe just take a step back quickly for the audience that haven't heard these terms, or that are familiar with them, but maybe just we can add a little bit more context or value around it. So when we're talking about forecasting or cash flow forecasting, budgeting, it's kind of all the same thing, but just a little bit of different terminology. I think there's a lot of value in making sure you've got a plan. I mean, if you start a business, they want a cash flow forecast for potentially up to 2 years, depending on what your projections look like.
But they being lenders or
lenders, yeah. If you're getting some funding for your business, but if like how far do you recommend companies are looking out, and what considerations are there? I mean, if you're paying for software costs, that are pretty substantial, and those are annual subscriptions that you're paying for, you want to know those costs are coming off. You want to know when they're coming off. Are there any other considerations around that you want to share?
So there's a lot there. When you're getting to the question about forecasting, and so when I say forecasting and dynamic forecasting, there's kind of multiple forms of forecasting that you can do. One form is cash flow forecasting. So you had talked about that, and so maybe just really quickly I can hop into what that is specifically. So cash flow forecasting kind of looks at your current cash position, so what your bank balance is right now, and then it takes into account things like what kind of cash is coming in. And you can do this on a weekly basis, bi-weekly basis, monthly, quarterly. Annual gets a little bit hard to start forecasting out cash flow. I mean, once you start going beyond, say, half a year, 9 months, there's a lot of speculation and a lot of unknowns that are going to factor themselves into a forecast. But it starts with your starting position, and then you have the cash that comes in from things like invoices that you've issued or financing, maybe that you've received. Cash comes in and cash goes out, right? So all your expenses, your payroll, paying yourself, whatever it might be, and then what's your bank balance at the end of that. So it's just a little spreadsheet. You can search cash flow template in Google, and you probably find many different downloadable versions. It's pretty straightforward. But yeah, if you do that, it helps you at least anticipate what your cash balance will be, months down the road, so that you're not going to find yourself in a cash constrained position without being able to prepare for it. And so, preparing for it can be making decisions about maybe not, moving forward with certain expenditures that you were perhaps otherwise going to, or maybe it means finding some financing options in the meantime, right? But essentially, once you get to that point where maybe you're seeing a bit of a cash cliff, you're now prepared to navigate that period. So that's sort of the cash flow forecasting part of it. The dynamic forecasting that I was mentioning is a bit more dynamic financial forecasting. So whereas if you have a budget, right? So everyone's kind of familiar with the idea of budgeting. You're like, okay, so our revenue budget might be, $1 million for the year. Cost of sales, maybe we're looking at like 500,000. Then we've got our overhead expenses. So you sort of set like monthly revenue and expense targets for, each of your line items on your income statement. And I'll try to bookmark this comment because I want to get back to this. It's not just the income statement. You should also be budgeting your balance sheet. But when you do that, that's a budget. And a lot of people do it. It's very important. It makes you think through how it is you're spending your money and where your revenue is going to be coming from. But then you want to be revisiting it. And so this gets back to our earlier conversation is you want to be revisiting that on a monthly basis if you can, because
Yeah.
things change, right? Your budget may
All
deviate.
the time.
Yeah,
Yeah.
exactly. And so if you don't revisit that, the budget is almost, I don't want to call it worthless because, we put a lot of time into these things and it gets you thinking through there's value in it for sure. But
Mhm.
the dynamic forecast idea is each month you're looking at how you did, what changed, what kind of assumptions may be changing in the upcoming months that may actually impact what your original budget was, and you forecast that out accordingly. Maybe you need to
Yeah.
hire somebody else, you put that in. Maybe some of the drivers of your revenue, which we talked about in a different episode, right, is maybe some of those assumptions are different as well, and so that may change your revenue assumptions. And so you're constantly recalibrating your financial forecast, and it gives you a really good pulse on how your business will do. And just real briefly, and I'm rambling on here, I apologize, but before I forget, so when you take that and you then allow it to feed into a balance sheet forecast, that will also be really helpful, because getting to your comment earlier about like financing or lenders, quite often they will require certain what you call lending covenants. And these are restrictions that they have in place to protect themselves as a lender. So they may say, we will lend this to you, but you have to maintain a current ratio of, say, 1.5, which is like a ratio that you can pull off of the data from your balance sheet,
Yeah.
right? Or they might say your debt to equity ratio needs to be below a certain point. So these are things you pull
Yeah.
off your balance sheet. So if you can forecast out your balance sheet then as well, you'll know if you're going to be onside or offside with respect to some of these lending covenants.
Lovely. So I got quite a lot out of out of there. So I mean, when you're doing your projections, I mean, how far do you recommend looking into the future?
Yeah, that's a good question. I'm going to give you the accountant answer, just that it depends. So
Yeah.
I like to have if I'm going to do an exercise like this, I want it to be pretty dialed in. Like I want it to be useful. And so I
Hmm.
would say a really good cash flow projection, probably 3 to 6 months is what you're looking at. I think
Three
anything
to six
beyond
months.
6 months, there's going to be a lot of factors that come into play that are going to throw. Yeah, put it this way: if you left your cash flow projection the way it is, your cash flow forecast, it will be wildly different than your actual come 6 months. So,
Yeah.
and same thing with a financial forecast. And so that's why, like the dynamicity, if that's a term, the dynamic
Yeah.
nature of it is that you're constantly updating it. So that you have a very realistic picture, right? So even cash flow forecasting, for example, ideally do it weekly, right? Because
Hmm.
every week things are changing in your cash flow. So if you can do cash flow forecasting weekly, you'll have a really good picture 4 weeks, 6 weeks from now of
Yeah.
what your cash balance is going to look like, and into like 6 months. But you'll have a really good picture within 6 weeks to make
So
decisions.
I got that. I think I would argue that I would say look a year ahead and bring some of that seasonality into your
Totally,
projections as
yeah,
well.
that's a
So
good point for
you can
sure.
start taking a look at your historical data, so your P&L and your balance sheet, and you can see what's happened in your business historically over the years. I mean, if you've been in business a couple of years, you can go back and you can see if there's
Yeah,
seasonality trends in there, and you can start introducing that into your projections as well.
for sure.
And that's the only reason why I'd say go a year ahead. I do understand that like that is kind of ambitious. You never know what macro or microeconomic
Totally.
considerations there are that are going to impact your business. You never know. I mean, like AI and how that's changed the way that people are doing things, and how
Hmm.
that impacts your business. You never know what
Yeah,
pandemic is lurking ahead of
that's
us.
right. Yeah.
So yeah, I mean,
Yeah,
a
you make
year
a good
out.
point there, Lyndon, for sure. So, sorry, just to cut you off.
Yep.
I think I guess when I say 6 months, it's like the real accurate forecasting. But absolutely, you
Yeah.
should be trying to project out 1, 3, 5 years is going to be a stretch, right? But
Yeah.
like strategic planning, you should do it once a year, and you should
Yeah.
plan out what you anticipate the year to look like, and maybe the next three. There's going to be a lot of assumptions baked into that, and you may need to pivot on those often, right? But
Yeah.
for sure, you make a good point there. Absolutely. Projecting out a year is very important, especially for budgeting and strategic
Yeah.
planning. Absolutely.
But good. I'm going to move us into the next part of the conversation, and then, if I remember, I want to come back to this to the cash flow forecast and how it ties in with your break even. So the next part that
Yeah.
we had planned for today's episode is break even. So Josh, I wonder if you can talk a little bit about that. Like, why is it important? What the hell is a break even? You know, like why is it important? And how do you bring that data or that information into making good decisions in the future?
Yeah, so your break even, at the end of the day, what it tells you is what do you need to do in terms of sales revenue to break even. And what does break even mean? It means after you've made a bunch of sales and run your business made $0 in net income. So when you're starting out a business, the first sale is always very exciting. As you're growing and building your business, all revenue is super exciting. You should still treat it as super exciting as it's established. You should honor your revenue because it's essentially a contract with your customers or your clients of what you're going to do for them. So there's a respect level there you should have for your revenue for sure. But what you need to realize is your revenue is a top line on the income statement, right? So you have other expenses that happen over the course of your business.
Fixed and
And
variable costs. Yeah.
exactly, yeah. So, and those things happen. And so at the end of the day, when everything shakes out, when you hit $0 of net income, you've essentially covered your costs as a business. That's your break even. And so that's going to be driven, you mentioned it just there, right? It's going to be driven by your price, but then also your variable costs and your fixed costs. Those are the drivers that impact your break even. Um,
Sorry, Josh, you froze up a little bit there. I don't know
oh, okay. Sorry
if
about
it's my
that.
connection or yours.
Okay, I
All
got
good.
stage right there,
Um,
maybe.
yeah, no, you went blurry, so you didn't have one of those funny looking faces when you froze up. Usually that happens to me.
Okay, good. As long as it looks normal, then I'm good with that.
Oh, yeah, all good.
Yeah, so hopefully that's a good summary. Like at the end of the day, it helps you understand what you need to do in terms of revenue or sales, either from
Yeah,
a revenue perspective, so like the dollar figure, or you can do it from a volume perspective as well. There's a calculation for it. We can put it in the comments, a link to that. You can also have a volume calculation. So like how many units or how many number of items do we need to sell? How many contracts do we have to do if they're roughly 30,000 each or whatever it might be? How many of these do we have to sell in order to break even? And then where this gets really important as a business owner is, we're all in business essentially to make a profit, right? And so once you know what that break even point is, then you add in the profit that you want to be making at the end of the day, right? And so you add that in, and then that will adjust your break even point, right? To make
yeah.
sure that you've got that profit coming out of it as well.
So, Josh, just one more question on the break even side of things. So, it's easy to calculate your fixed costs because that's kind of like a given every month. So
Yeah.
how do you calculate? I mean, what is your take on calculating the break even when you have like variable costs to consider? I mean, maybe you can just run us through that at a high level.
Sure, without getting hyper mathy. So,
Yeah,
yeah, good question. So your variable cost best defined. I don't know if it's best defined. There's probably better definitions out there, but I'm going to try my best to define it here. Essentially, our variable costs are the costs that you have that will change as the volume of your sales changes. So, say for example, I sell flooring. Okay, like a
mhm,
flooring distribution center. So I've got my warehouse that people come into to sell. So say I spend $10,000 a month in rent there. So that's going to be a fixed cost. Whether I sell a ton of flooring or nobody walks into my warehouse, I still spend $10,000 a month on my rent for that warehouse. And
yeah,
so now if I have people installing flooring, then I've got labor, right? And then I've got materials. Those things will change with each of my sales. So as soon as I sell, put in like 25,000 square feet around this big, like maybe a retail store or something, right? Then all of a sudden I have materials costs, I've got labor costs, I've got transport costs. These are all tied to the delivery of my sales. And so then the idea is how many of those do you need to do to cover those fixed expenses in order to break even?
yeah. The more projects or jobs you take on, that break even amount's going to increase.
Yeah. So, yeah. And the challenge is like, and especially as a contractor, you're going to have different differing types of services or sales or contract types that you offer, right? You might have a bathroom, you might have bedrooms, you might have full house reno. Maybe it depends on the type of the house. So maybe it's on a square footage basis that you calculate this, right? You're like, okay, well, so generally speaking, on a square footage basis, our price ends up being this. Our variable costs, which are the costs that we incur to do the project, and end up being this on a square footage basis. And so our contribution margin, the amount that contributes to our fixed overhead and profit at the end of the day, is $2, maybe a square foot or whatever it might be. So then you're
Yeah.
like, we need to sell X amount of square feet in projects in order to either break even or to hit a certain profit. So it gives you a target to shoot for.
Got it. All right. Awesome. All right. I'm gonna pull it back to the point that I made earlier. So having your break even and tying that into your cash flow forecast is really valuable, because now when you start doing that strategic planning and you start setting goals for the quarter that you can bring back to daily, weekly, monthly goals, and even like your long-term goals, like the longer term. I wouldn't say long-term by any means. A year is not a long term, but your longer term goals, like your annual targets that you have, understanding what that break even is and what those margins are from that break even. Margins, not probably not the right word to use there, but that profitability above break even, um, what that looks like. Have you frozen there, or are you just looking at me very
Oh,
funny?
I'm just looking at you very intently, Lyndon. I'm like, okay, what's he asking here?
Not asking, it's more of a statement, like
Sure.
so
Okay.
when you're doing your break even, and you've got those numbers, it empowers you, or it allows you to actually start doing some better planning,
Yeah.
for your sales team, your marketing team, your ops team.
Yeah.
And yeah, I think
Yeah.
that's
Because And that's an important point, because if, say, for example, like getting to your planning comment there, if you understand what your break even point is, and then if somebody says, "Hey, we should invest in another salesperson, or we should bring in somebody else on our team to help with this," you'll know what the impact is on your sales requirements in order to break even. Right? You're like, okay, if I add somebody, what's this going to do to my overall projection, my overall
yeah.
target for sales?
Is that where that dynamic forecasting that you're talking about comes into play? So when you hit that roadblock or that speed bump on the journey across Canada or whatever, um, and you need to recalibrate and take another route, then you can calculate, like, oh, it's going to cost me an extra, $6,000 or $10,000 for this salesperson, and then we got to factor in their commissions and everything else. That's what it's going to look like, and you have that dynamic forecast. So it's just recalibrating that forecast so that you know whether or not this is a feasible decision to make now or in 3 months from now.
Yeah, and so the break-even analysis itself and the tool that we can provide here is like more snapshot based. So it's like, okay, so
Mhm.
if we have this cost structure in place, this is how much we have to do in revenue to break even. The dynamic forecasting, we use a tool that essentially lays out like 12 months in advance and bakes in certain assumptions. So if you have revenue drivers that are based on, say, a square footage basis, we can put that in there. Be like, okay, so for every square footage, you're bringing in this much revenue, and so how much do we need to be selling in order to hit your revenue targets? And then we'll actually forecast out the expenses, so like a budget, but then each month we update it to see what your income looks like over the next 12 months. So it's essentially a forecasted income statement and balance sheet that changes each month as your business has been operating, whereas, say, like a break-even analysis just looks at, okay, at the end of the day, what do we have to do for sales to break even this month, right?
Yeah.
So, yeah.
Yeah, no, I got that. I think, I mean, yeah, 100% agree with you there. All right, super. So, Josh, I mean, I think we can wrap this up today. So, what is like one key takeaway, one golden nugget that you'd like to leave the listeners with?
A golden nugget. It might just be higher level this time for me. So, just the idea. I always say that the numbers tell a story, right? And so, we've talked a lot about like where the numbers are sitting today. So, you've got your financial statements, you have your cash flow forecast. If you do that, it's going to help you decide, um, you know, your expenditures and your cash burn. And then you've got your break even analysis, and so it helps you understand how much you have to have in terms of sales to hit certain profitability targets. So All of these are different tools that help you better understand your business, and ultimately they tell a story. And so you want to better understand the numbers so that you can understand the story of your business. And when you understand that story, you can be a lot more proactive in writing it instead of just reading it a year later when you're looking at your financials, if that's kind of the cadence that you're
Yeah.
currently using.
Yeah, excellent. And I think just to add to that is looking in the rearview mirror is great. It allows you to make excellent decisions moving forward, but you do need to plan for the future. You can't plan for the future without looking at what's happened in the past, and
Mm-hmm.
that's why your P&L, your income statement, your balance sheet, why that's extremely valuable. But you take that data and you apply that into your forecasting or budgeting, and
Mm-hmm.
it empowers you to make really better decisions. So to your point, it's a great tool for decision making, and also just to keep track on keep your finger on the pulse and make sure that your business is actually profitable and you're not chewing away funds unknowingly, right?
For sure. And if I can maybe like add a secondary nugget just kind of related to that, is it's a much better way of doing that than simply looking at your bank balance right now and being like, oh, this is how we're doing, because that's not the
Yeah.
best way to make decisions for your business.
And that's like a cash flow thing. We can get into that in
Yeah.
another episode completely. And yeah, so we'll leave that there. But thanks for everybody that's listening to us today, and thanks Josh for your insights, your financial insights and experience there. I get to learn a little bit every time we have these conversations. So I appreciate you, and
Yeah,
I'm
as
sure the
do I.
listeners do
These are
too.
good conversations for sure.
Yeah. And yeah, we're looking forward to joining you guys joining us for another episode of the Business Growth Factor. And again, it's conversations about building better businesses. Thank you, and we'll chat to you soon.
Awesome. Thank you.